Good morning to our wonderful audience out there, and welcome back to Boutiques on Wednesdays. South Africa fixed income assets are super attractive at the moment on any measuring matrix, but this is undeniably true for fixed deposit rates offered by banks as well. So perhaps you are looking for a good alternative with low volatility. Large chunks of clients' portfolios are exposed to fixed income assets, and with attractive yields at the moment, some of you may consider increasing your SA bond exposure. The question then is what bond fund to choose and what manager to use. But what about growth assets, especially global equity? Are there more tailwinds for cyclical growth assets? And is the global recession can being kicked down the road? Who knows? All this and more this morning on Boutiques on Wednesdays, and it is my absolute pleasure to welcome two formidable fund managers from Vunani Fund Managers, Rowan Williams-Short and Rory Spanenberg, to look at their SA fixed income solutions and the Vunani BCI Global Macro Fund. Many thanks for joining us this morning, Rowan and Rory. We are really looking forward to your presentations. Rowan, I believe you're going to go first, followed by Rory, and the audience, as you know, keep those questions coming. Through the presentations, we'll try to cover as most of those questions as we can after both presentations. Thanks.
Thank you, Eugene. First of all, thank you to BCI for inviting Rory and I this morning, and thank you to everybody who has joined the call. Maybe, Eugene, you could just confirm that my screen is showing correctly.
Yeah, absolutely.
Fantastic.
Thanks,
okay, so thank you. I'm speaking to you this morning representing two funds, the Vunani BCI Bond Fund and the Vunani BCI Short-Term Interest Fund. Thank you. Okay, at the risk of offending my hosts who asked me to speak about the outlook, I'm going to begin by defending not giving you an outlook. So please indulge me, Eugene. I do intend to explain that. Speaking about an outlook is the most common, the most popular topic on the agenda of every investment conference. I've always been a bit contrarian in both my approach to equities over many years and over bonds for 30 years now. I'm going to just observe that the most pointless thing that I read in outlooks, and I see sell-side research, not my competitor research, we are in uncertain times. I cannot think of a more pointless observation to make. And then I'm going to show you that it's not necessary to do these hazardous things. It's perfectly possible to deliver reliable positive alpha without the hazard of thinking you have a crystal ball. And then, of course, I'll just finish up with a brief overview of those two funds which I mentioned before I hand over to Rory. So how do forecasts go? Well, they go horrifically badly. Let's just take for the one that's probably the single most important metric for a fixed income manager, which is forecasts of inflation. I have gathered the data for 22 years now. So the gray bar is the Reserve Bank's target, 3 to 6%. The black line is South Africa's supposedly top economists drawn from academia, asset management, and business on the outlook for inflation. The blue line is the same thing, but 2 years ahead instead of 1 year ahead. And now we can superimpose 22 years worth of data of the actual outcome of inflation. As you can see, it's embarrassingly bad. The average absolute area is 208 basis points just 1 year out. How that's helpful is obviously, well, the answer is tautological. It's not helpful. It can't be used. These inflation forecasts are just terrible. Furthermore, you can see that, in fact, the black line, the supposed forecast, if anything, lags the truth. It certainly doesn't anticipate it. And even now, having got it horribly wrong again throughout 21 and 22, I can't see because I've got you guys on video, but you can see that there's currently a reaction going into 2023 and 2024, which is a bizarre kind of attempt to correct the mistake of 21 and 22. So even as inflation has clearly peaked, we now see these forecasts trying to correct the error of last year. It's crazy. And it's just the same, except worse in America. So for many, many, many years, American economists just expected inflation to be 2.25. We now know that instead we got 4-decade high inflation last year. And the really weird thing is, if you look to the far right of that chart, you will see that now, having been just embarrassingly wrong in 2022, we now have the forecast for 2032 increasing. How does this ameliorate how bad you were in 2022? So there's crazy behavior going on there. Let's take one more. The Bank of England, so not the private sector now. And here you can see the progression of their inflation forecasts starting in 2020. And there is no forecast going on. All that's happening is a sort of an apology for realized inflation. So up and up it went in the face of just calibrating how bad the previous forecast had been. So these things are unusable. I have one more for you, shared with me by an actuary called Emlyn Flint at Perisec. So I just want to give him a tip of the hat for sending this to me, because he and I discuss these things a lot. Here we have 15 asset classes, ranging from the best known on the left, US large cap equity. Then we have US small cap equity. Then we have developed market, non-US, and so on. You can read all the titles yourself. We have bonds. We have corporate bonds or high yield bonds. We have TIPS, which are the American equivalent of inflation-linked bonds, and we go all the way to private equity. Right, so for each asset class, the gray bar is the range of forecasts made by these self-declared experts. I mean that, self-declared, not measured, from the most pessimistic to the most optimistic. The orange dot for each asset class is the consensus, which by definition then lies within the gray bar, and oh dear, the yellow dot is the outcome. Now, this is quite staggering. In all 15 asset classes, the yellow dot not once was within range. Not one outcome was within the range. So if you think this is bad for fixed income, you can now see that it's bad for all asset classes. I actually believe it's even more hazardous in equities. One of the most formative studies I ever saw in the Financial Analyst Journal many years ago was a study of 144,000 company earnings forecasts across 12 developed markets, and the average error 1 year ahead was 44%. I recently was able to obtain something similar for South Africa, going back many years, retrieving 43,000 company earnings forecasts 1 year ahead. And two things: the error rate is really bad. Three things, actually. The second thing is it's been getting worse. The third thing is one shouldn't be overly surprised. Everybody will point to much better technology than ever available previously, and we have far more data available to us than ever before. So that's all changed. What has not changed is human psychology. The rank over-optimism of forecasters of company earnings will never change, despite the advent of behavioral finance. So all these biases are well documented, but they don't stop human beings from this over-optimism tendency within equities. And as you can see here as well, the range of the gray bars is bizarrely small, especially if you look at commodities towards the right-hand side there. On what planet would you imagine such a small range for commodities? So what's going on there is just plain yellow-bellied cowardice, and this will cluster around the consensus to avoid extreme embarrassment if they're wrong, rather than putting down their best forecast. So Eugene, this is why I'm nervous of outlooks. I want to now switch to, we don't need an outlook, guys. We really don't. There's plenty of ways to make alpha through hard bottom-up fundamental research. So what I've done here is take the All Bond Index. The orange line is the exact return of the All Bond Index. It matches the precise, ordinary, old-fashioned accounting methodology of what the return was. But we have, that's just for client reporting. There's no insight to that. So we've created a sophisticated attribution and contribution model. And what I've done is decompose the sources by factor of the All Bonds returns over the past 10 years, 2013 to 2023. And then I've, just for the sake of simplicity for this morning, given the time, I've taken 4 of those factors and grouped them into something I'll call the passage of time. So unlike in equity, a bond's price changes on a Sunday, or changes on Easter Friday, even when the markets are closed. The 4 factors contribute to that. We can go into detail in question time if you like. Those, as you can see, is the lovely, smooth, slightly convex blue line. The orange line is the factual combination of all 7 factors, which matches the Orbi. The green is for when we do corporate bonds in actual funds. It's not relevant to the All Bond Index. And now let's come to the red line. The red line is the outlook. It's the forecast. So there's 2 sharp, like equity markets, bond markets returns never spike upwards materially, but from time to time there's a problem, they spike downwards materially. So December 2015 was Zuma firing Nene, and March 2020 was the start of level 5 lockdown. Both of those were unforeseen by the entire market, which is exactly why they hit the market so hard. So no amount of outlook could have anticipated those. But I want you to please examine that red line. It is a pure random walk. May I just put in a word, Eugene? 2022 marked the 50th anniversary since the publication of one of the most important investment books ever, A Random Walk Down Wall Street. Well, that author is alive and going, and I'm inclined to send him the red line. The bond market in South Africa, the news is axiomatically a surprise. Otherwise, it's not news. So the red line is random. So much for the outlook. Why would I, as a fiduciary in looking after other people's money, attempt to manage it, imagining I can predict a random walk? Therefore, the outlook has been obviated from my process for many, many years. A final word on that. If I'm going to go around forecasting inflation or the oil price or the rand dollar exchange rate, well, we've just seen how difficult that would be. But secondly, if I'm going to use such forecasts, not only does my forecast need to turn out accurate, which is a bit of a pipe dream, but it needs to be in the minority. I need to be kind of the only guy who got that consensus forecast right. Because if it's a consensus forecast that comes right, it was already in the share price or the bond price. Now, to attempt both of those, really, guys, let's be more realistic. That's just misplaced ego if you think you can do both of those. So our approach in both the Vunani BCI fixed income funds is to pursue modest accretive alpha, no heroics. I can demonstrate this over several episodes in my career, starting at Prudential Portfolio Managers and again at Vunani, where our funds never come first in a peer group over a month. And if they did, I would be shocked and disappointed, but they also never come last. And the net result is when you wait 3 to 5 years and more, they have gently risen to top quartile, no heroics. And it's not just about me not wanting to try that kind of hazardous stuff. It's me recognizing a fiduciary duty that is other people's money. This is not experimental fun for the fund manager. It's proper fiduciary duty. So I might never again be invited to a BCI conference, but thank you so much for inviting me to give my outlook. And the answer is I have no outlook. Well, at least I don't have one of any use to anybody in this audience today or to me. I, like the next guy, I'm a human being. I have feelings in my waters. I have instincts, but I do not inflict either of those on other people's money. So on top of that, I don't know about you guys, but I'm not a masochist. So I don't make forecasts because I don't actually like to set myself up for certain failure. I'm going to say a little last word on this. These self-declared experts that go around pronouncing on the shape of the world next year, and let's face it, 2022 was one of the worst for those forecasts. I've gone and looked at millions of forecasts from 2021 for 2022, and they all were hopelessly bad. And yes, you can blame it on the war in Ukraine, and you can blame it on 40-year high inflation. Problem is, every year of my 33-year career, something has come along to upset forecasts, whether it was the war in Iraq, the Fukushima nuclear disaster in Japan, the assassination of Chris Hani. Every year, there's something that these guys can try to pass off why their forecasts are bad. Has anybody in this audience ever seen a top-down strategist forecaster ever publish a scientifically honest assessment of their forecasts? You won't see it. And that academic dishonesty kind of irritates me a bit, which is why I showed you, I've done it where they won't. I've collected those forecast consensus. And I don't blame them, they're not idiots. These things are just too difficult for human beings to do. Stand up and recognize that. And yeah, are these the two most pointless statements that you read in these grand sweeping outlook and strategy documents? The outlook is uncertain. I must read that 5 times a day. And we expect further volatility. I invite you to think of the opposite, everybody in the audience. Imagine you read one day from somebody, the outlook is certain, but I mean, immediately book him a place in the asylum, and we expect no further volatility. Since those two statements are patently idiotic, then the opposite statement must be equally idiotic. Every single day of every single year, the outlook is uncertain. Every single day in the history of financial markets, there has been volatility. Why would you therefore point out the obvious and try to look clever doing that? Those are pointless statements. Disregard it and probably close that document and save yourself some time. Okay, the two funds that we love managing as the co-branding of Vunani and BCI are both still youngsters, so they don't have statistical merit yet, and they certainly are not yet conducive to an attribution analysis. So I'm going to rather show you first of all, our GIPS composite. So we are GIPS verified and certified by Deloitte. This is the bond track record that I've produced over 15.5 years. And I wish to assure you that not once was any private forecast of mine brought to bear on the management of these funds. Not once. But for 15.5 years, we have an information ratio of +1, a Sortino ratio of +1.6, and a simple crude alpha of 150, devoid totally of forecasting or forming outlooks. And I'm going to come in on time. Early days, as I mentioned, but the Vunani BCI bond fund is nicely well ahead of its benchmark, the All Bond Index. If that can be done consistently, that will translate as day follows night into also looking pretty good on the peer group. Since we don't have it since inception because it's not a 2-year anniversary, so the longest is 2 years in the surveys. It is second quartile, and the even lower risk fund that we run, the Vunani BCI short-term interest fund, also miles ahead of benchmark and first quartile over 1 and 2 years. With that, I thank you. I understand from our host, Eugene, that we won't be taking questions on fixed income at this point. We'll first, Rory will present on global macro, and then Rory and I will both be here, and we are not limited to your time. We've left lots of time open for you guys, and really look forward to the questions. Thank you very much once again for giving us this time. I'm going to flick screens, and Rory will now present global macro.
Thanks, Rowan.
Thank you.
Yeah.
Yeah,
Right.
perfect.
Just, Rowan, thank you, Rowan, and also to the BCI team for the invite. Rowan hasn't rushed off to answer angry emails from all the forecasters. He's right with me. And maybe I should just start by sort of linking our two presentations. And naturally, what we do, our focuses are quite different. But the message we're trying to send today with the BCI Global Macro Fund is that, thankfully, listening to Rowan, I can say we spend very little time, or in fact no time, forecasting earnings, and also not thinking about the future too much. We instead focus our attention on trying to understand competitive advantage, the fundamentals of individual companies, and then we take a very humble approach, I would say, to trying to understand the valuation of those companies and very determinedly avoid point estimates in valuation, which I think is clearly fallacy. And what that translates to ultimately, in our view, is a layering of margin of safety, both at the individual company level, the valuation of those companies, as well as at the portfolio level. And so rather than thinking about margin of safety, I think as people typically do, as a sort of single number or a discount to an intrinsic value, we tend to think of a margin of safety as something that builds up over the full analysis process when approaching equities. And that, I think, translates very clearly into better risk-adjusted returns. So many of you might be familiar or aware of the fact that I assumed responsibility for the global equity team at Vunani almost a year ago, at the start of April last year, to take over from Tony Bell, who had left. In that time, we have put the global equity process at Vunani very much on a fundamental footing. Gershwin, who's been with Vunani for 2 years, for 4 years, had worked with Tony for the 2 years prior to that. I'm very excited to be able to announce that we also have a new joiner at the start of next month who's accepted an offer from us to complement the team. And that pretty much, I think, fleshes out our capability in global equities. And I'll also talk a little bit about how we approach a very large and diverse universe and why we think we are adequately staffed at this point. My own history, in fact, I partnered with BCI 7 years ago to launch a global flexible fund, which ultimately then became the North Star Global Flexible Fund. was relatively successful in managing that fund. And what we're looking to do with the BCI Global Macro Fund very much draws from that experience, as well as my 10-year experience at Investec, including in global equities prior to joining Northstar. So I talked about margin of safety and also the future. We are determinedly focused on competitive advantage. In fact, we think of ourselves as students of competitive advantage. So this approach is, something that I've been working on and incrementally sort of enhancing over the last 10 years. And it's focused very much on McKinsey's 50+ year study in corporate value creation, and effectively what they've been able to demonstrate, I think quite convincingly. And what interests us is that there is clearly a small group of companies, because of competitive advantage, that can sustain high returns on capital, which is illustrated in this graph. And even though those returns do demonstrate some sort of fade rate, after a 15-year period, so rolling 15 years over which they conducted this exercise, those companies, that group of companies, continue to generate returns comfortably above their cost of capital and significantly higher than peers. And those are your typical compounders, and that's the sort of the bread and butter of our universe. Good quality companies that can sustain those high quality characteristics. So we look for differentiated insights into why we think that might be the case and where it's not necessarily reflected in the price. Another more interesting area of potential return is looking at companies represented here by the bottom line, those that demonstrate positive incremental returns, and our screening process identifies those, where you have the benefit both of improving fundamental performance as well as a re-rating associated with that as the market recognizes and then reprices those shares accordingly. So those are the two buckets of potential return we try and identify. In terms of our own thinking and approach, and where we think we may, or something we demand of ourselves and translates ultimately into our own competitive edge, is that in my mind, the market is, and this links again to what Rowan had to say, typically focused on a forecast or investment time horizon of 3 to 5 years, where Michael Mabusian has demonstrated here also that corporate value is just not created in that way. And so thinking about it in a very linear fashion and over definitely a far too short a time horizon implies that you leave a lot of value on the table. So the residual in any model is the unexplained part is generally too large to satisfy anyone who has any intellectual curiosity about these things. And so what we try to do is focus very much on the medium to long term and develop a far more nuanced approach or assessment of value. And that also, I think, comes through very strongly ultimately in how we construct portfolios, holding periods, etc. So just to mention very briefly our quantitative approach, how as a team of 3 do we wrap our arms around a very diverse and complex universe. We start each quarter with a screening process. This is something I've been doing for the last 10 years, ranking all members of the MSCI All Country World, 2,000 plus companies, trying to identify capital efficiency, cash generation, and sort of prudently financed qualities, as well as a high-level approach to how reasonably valued they may or may not be. So for each of the bubbles on the screen, we would score companies. We take the top 50 each quarter and then put them through a persistency and recency test, which means you're not flooding your fundamental process with new ideas every quarter. Rather, you are using the screening to develop a settled master list of companies. We work with about 250 companies, which over time you get to know better and better, with the comfort of knowing that they meet your quality criteria, at least quantitatively and in a backward-looking sense. The forward-looking fundamental work is where we spend the overwhelming majority of our time applying a 4-pillar fundamental framework, again, interrogating companies on the basis of the industry landscape, the competitive advantage, the source, trend, and duration, sustainability in its broadest sense, and then also an assessment of management, the strategy, their track record. We are students also of remuneration models and incentives, and very keen to understand how they align with our own position as minority investors. We score out of 100 each of those 4 pillars, well, a total of 125 each. And then that score translates into what we call a fundamental risk rating. And that informs directly how much we can invest in each of those companies. So the lower fundamental risk we perceive, the higher the weighting in the portfolio, and so forth. And then how we manage the portfolio or the positioning towards those maximums is a function of the valuation. I mentioned we don't take point estimates. We work on a scenario-based approach that's both in the investment case or our assessment of the investment case, as well as the valuation. So each company, each of the 100 companies now on our buy list will have a bull, bear, and base case estimate. Important to mention, estimate of intrinsic value, and a probability assigned to each of those cases. And that provides incredibly rich source of data from which to build portfolios and how to think about holding periods. So I challenge the analysts working with me and myself as well. I'm very much involved in the research process to settle very early on in the research process on a working hypothesis or investment thesis for each of the companies we own. And this becomes very much a guidepost from which we judge all subsequent news flow and results, and the insights we develop right in the early phases of our approach generally means that there's a lot less heavy lifting involved. Goldman Sachs may report overnight, but we know that there's only 3 or 4 key yardsticks by which we need to measure them to ensure that the investment case holds. So that certainly makes the job a lot easier. I mentioned that our approach to both risk and valuation becomes incredibly valuable from a portfolio construction point of view. This just represents or illustrates how we take all 100 companies on the buy list, the risk ratings, as well as the intrinsic value and the spread between the bull and the bear case, and translate that ultimately into a portfolio. So each of the bubbles on the slide represent an individual stock on the buy list, each of the 100. On the left hand, on the y-axis, you see the probability weighted expected return. So that's having applied a probability each of the 3 scenarios, bull, bear, and base. And then the spread between that bull case and the bear case, which tells you something about forecast risk or variability in potential future outcomes. So you'd think the lower the risk, the narrower the spread between bull and bear. And what we're trying to do is optimize or build the portfolio in such a way that we optimize that red dot for each of the dots on the portfolio, the red dot representing the portfolio, and then optimize towards the top left. So higher prospective return across all 3 scenarios for less forecast or variability in future returns. And so while we are resolutely long-term holders of companies, and they're companies we own in the portfolio today, which I've been a holder of since I launched a global equity product at Investec more than 10 years ago, we certainly approach the sizing of those portfolios, of those stocks in the portfolio very dynamically. And I think the way we've set ourselves up also means that we're able to deliver a very active management of the portfolio. So having that proprietary data at our fingertips also means that we can approach a fund like the Global Macro Fund and its risk tolerance or the setting of the equity weighting in the portfolio from a bottom-up perspective. So this is very early on in the process, and I accept that. But something that we monitor daily, and in fact we minute at each of our global equity meetings, is the underlying probability weighted intrinsic value discount of our buy list. And then we also measure that against subsequent returns. And what you see here is through the course of 2022, post May when I took over, we took a month or so to rebuild a buy list. but that underlying intrinsic value discount and the subsequent 12-week return, which is not a long-term return by any stretch of the imagination. I accept that. But it is a guide to how useful this might be. And I included it to demonstrate and to explain also the position we've taken late in January to underweight equities for the first time, having now built out the buy list and also I think built up the confidence we have in the intrinsic value discount and that what that might be telling us about prospective returns. Vunani, you would know, has a long-term track record in global equity and in active equity that will reach 10 years in May. A very commendable track record that also. But this is just a more recent snapshot of what we've been able to deliver in the time that I've been responsible for the portfolio. So going back to May last year, which again I accept is not a very long track record at all. I would refer you to sort of what is in the public domain and my time in North Star. But what I can say is that two things give me confidence. That firstly, we've been able to keep up with the composite benchmark, which is a benchmark comprised of 80% of the MSCI World Index, 20% in cash, split 15 to dollars and 5% to rands. And what is pleasing to see is that some of the downside protection that you would expect to see from the process which I've outlined is beginning to reflect in the return profile of the portfolio. So compared here also to the MSCI World, you can see far lower drawdowns. And in fact, coming out after sort of 10 months that we have under the belt now, ahead of the MSCI World Index. So what you can anticipate from a portfolio like this, I think going forward, is that we would certainly look to maintain our exposure to equities and participate in equity upside, probably giving up some of the upside in months that we saw, for example, last month, where the index does 7 or 8%, but to make all of that up in the downside. So an asymmetry in the return profile, which stems from an insistence on a layering of margin of safety, and which I think, and hopefully I've given you some insight as to how we get there through a very disciplined and nuanced approach to both fundamental and valuation risk. So thank you, Eugene. I think that's done relatively well to come in almost on the 15-minute mark. So Rowan and I both here and happy to take questions.
Robert and Rory, thank you for that very inspiring presentations. And as I mentioned in my introduction to formidable fund managers, you both made mention the funds may be young, but you've got an extensive track record in managing these kind of mandates. And if you look at the track record as well, like I said, absolutely inspiring. Rory, if I can maybe start from our side and maybe unpacking your fund or your portfolio construction process a little bit more by looking maybe at 2 or 3 examples. The data that I've got is a little bit stale. It's never 100% up to date, but I see some of your top holdings are companies like Visa and MasterCard and Alphabet. Can you maybe just chat us through those holdings? And we understand your portfolio construction process, but when you apply that to those companies, what excites you in holding them?
Well, let me start with Visa and MasterCard, because those are 2 of only 3 companies currently on our buy list that we consider to be low risk, fundamental risk, that is. And that really speaks directly to our assessment of the strength of their competitive advantage and most notably the double-sided network from which they benefit. Much has been made about the threat of fintech disruption, and yet what we see in practice is that many of the new entrants to the payments landscape have actually chosen to partner with the card companies as opposed to tackling them head on. You may, a very obvious example might be, the introduction of Apple Pay. If you go back probably 7 or 8 years now, there was a lot of concern about what that Apple's entry into the payments landscape might mean for the card companies. I think Apple quite quickly realized that rather than challenge that double-sided network, which brings together both merchants and card issuers. It was far better to co-opt the two card companies as partners. And you see that with any number of entrants into the payments landscape. We do keep a close eye on developments in a place like India, where maybe the card companies are not as position is not as entrenched. And that may or may not offer some clues as to what the payments landscape looks like over time, as well as the growing threat of sort of nationalism of payments networks. So those I would identify as two of the risks which we focus on. But we think that an obsessive focus on those risks also maybe takes away from the opportunity and the runway that still exists in many, many countries, even in developed markets such as the US, where cash is still very prevalent. And the cash to card opportunity that these companies benefit from and the structural growth underpin that affords them remains very, very attractive. And then on Alphabet, a chart that I like to put up, which I think demonstrates just very convincingly the strength of their own competitive position. And I can contrast that also to some of our thoughts on Meta or Facebook. Both companies sell digital advertising. The utility value of search, in my view, is far greater than social media, and therefore we own Alphabet and not Meta. If you look at market share of search for Google, it's in excess of 90%, and even in the European market where regulation has been most pronounced. And go back to 2016 when the European regulators forced Google to stop Android handset makers from installing it as a sort of default search option. Market share, dipped by 0.5% and recovered almost immediately. So that, I think, speaks overwhelmingly to the entrenched nature of Google's search dominance, and everything else sort of really just follows from that. And while digital advertising through the pandemic certainly, the growth that they saw was probably not sustainable and is now reverting sort of more sustainable trend rate. I have a great degree of confidence in their market position, as well as the fact that you pay very little for the core business. In fact, a low teen PE.
Yep. Thanks for that. Rory, I'm going to stay with you. Rowan, I didn't forget about you. I do have a question or two for you. A lot of questions coming in from the audience as well. One of the questions, Rory, speaks to your asset allocation in global macro at the moment. And again, looking at data that I've got, it looks like you at maximum fixed income or cash holdings at the moment, sitting roughly at about 20%, where there's a big chunk allocated to global bonds. Maybe just for the audience, do we read anything into that? Why you're not fully invested? Are you keeping some dry powder? Are you just looking for other opportunities? And then your views on global bonds, because I see you've got a healthy allocation to global bonds as well.
Just for clarity, a neutral stance for us would be 80% in equity and 20% to cash, of which 15% of the benchmark is the FTSE 3-month T-bill index and 5% to the STEFI. So for the entirety of the period that I've been responsible for the portfolio, we've maintained a neutral stance up until late in January, where we've made the decision, because of the underlying intrinsic value discount that we observe from our buy list, to underweight equities. So our exposure to bonds is really in short-dated T-bills, a weighted duration of less than 3 months, in fact, right now. And that's really just to enhance the yield that we receive. We started buying T-bills. You can buy 3-month T-bills on around 4%. We get a lot less than that in just having it in settlement. So that's the rationale for that. So it's not really I don't necessarily think of it as a call on bonds or a bond position. It's rather just sweating the cash to some extent. And then the decision to underweight equities, having built up the conviction now in the signals we're getting from our buy list and the attractiveness or not of that buy list discount, which is midway through last year, June, July, was approaching 30%. And then we saw quite a strong rally in the second half of last year, which sort of sustained into January. That intrinsic value discount is now in very low single digits. So we don't find global equities particularly attractive right now. I would say the bull case, and I would argue that what's transpiring right now, the bull case for equities is a very dovish Fed and a re-rating of global equities on the assumption that interest rates are cut this year, or that the Fed pauses. And that in itself should raise some questions perhaps about the outlook for the global economy and the attractiveness of equities. But if you think about it sort of just simplistically from a high level point of view, we saw a derating of global equities last year from 19 times to 15 times, which is roughly one standard deviation above long run average to the average. And then despite having Rowan right here, I'm going to quote the consensus earnings growth expectation for the calendar year, which is when I last checked about a week ago, about 3.5%, which is not exactly something to get too excited about. So if you have a market that's fairly valued, an earnings growth outlook that is, I would say, quite modest, and then the risk to that earnings outlook, which is my primary concern, is that it's very concentrated in a small number of highly cyclical areas of the market, most notably in energy. In fact, energy contributes more than 100% of the entire market's earnings growth expectation, at least for the calendar year. That's not something that I would necessarily hang my hat on. And for that reason, we've just decided to take a more conservative stance. And so in the last week of January, we reduced our equity exposure from 80 to 75%, which is the lowest it's been in, I think, probably the duration of this fund.
Thank you for that, Rowan. We're running short of time. Just a quick question on your bond fund. And I mean, you've mentioned in previous presentations, it's all about yield. Looking at your bond fund and the constant outperformance on the all bond index, how do you achieve that? Is it active management on the duration curve, or do you purely focus on trying to get the best yields?
Okay, thanks, Eugene. So we are very, very seldom active on overall duration. To take an overall active duration, let's say the ALB is at 7 and I choose to be at 6 or 8, for argument's sake. That is a declaration that the rest of the market is wrong. I don't go around doing that a lot, okay? It may be an implicit declaration, but think about it, it's actually explicit. I don't go around saying everybody else is a fool and I know better. That's just not part of my process. So overall duration, we wait for spasmodic events of dystopia and utopia. For example, 16th of December 2015, we had a good finance minister, and then we had a, whatever he was, 48-hour finance minister nobody had heard of, and then we got a good run again. The market priced as though Zuma was only ever going to put unheard of, incapable, incompetent finance ministers in, but the private sector changed its mind on a weekend. So you had dystopian pricing then. Those are the rare events which are behaviorally induced into the market, where we'll take an overall duration position, but it's seldom. I don't go around declaring all of you are wrong and I'm right. However, key rate duration, Eugene, is a sort of more subtle building block approach to overall duration, and we have, finessed that down to the decimal points. So yes, a lot of the time in the history of the short history of the BCI bond fund, we chose to be overweight in low duration floating rate notes at the short end of the curve, made up for in overexposure to long end government bonds. That worked out really, really well because you've heard me say this, Eugene. In 2020, the the most unprecedented thing in truth was the unprecedented frequency of the misuse of the word unprecedented. So every second thing was described as unprecedented, and nothing was. Equity markets here and abroad were not unprecedented by any measure unless you bought the cheapest history book on the shelf that only went back about 6 months. We had seen much bigger drawdowns in equities and bonds here and abroad. But one little thing was unprecedented, and that was the steepness of the yield curve in South Africa. So that was justified. So it was still neutral overall modified duration, but the building blocks were heavily active. And then, yes, the second component is perennial, has been for me since I was the original CIO of Prudential in 1994. There will always be yield enhancement. This is engineered carefully. Our funds will always yield more than benchmark. And that is now almost back into Rory's territory. That's bottom-up stock selection. I know the difference between a Standard Bank Tier 2 instrument and an ABSA AT1. We have really nice valuation models for those. And I'll pass an overall judgment. The advent of floating rate notes, especially by the banks at varying levels of subordination, was poorly misunderstood, just like inflation-linked bonds were 20 years ago, and therefore mispricing was widespread. That has run its course, and I see a kind of Johnny-come-lately approach to bank floating rate notes now. We saw the last two auctions in the past 10 days were records in South African history, and everybody who missed out on that party is coming in. That's about the time I like to go out. If I could share an equity anecdote with you, Eugene, quite a fun story. 99-2000, I went in the same week to management presentations as an equity guy then, of Dimension Data and of De Beers. The Dimension Data was standing room only. Literally, they had to get ushers to kind of squeeze people in and stand around. De Beers, despite being more than a century old at that time, having a near monopoly in its own sector, which Data certainly didn't, couldn't find analysts to attend their Cape Town roadshow. So they afforded us one-on-one opportunity. I sat for the first time, unheard of, for an hour and a half with the CEO of De Beers. In the past, they were quite a snooty company, if I may be so blunt, that everything was on their terms. Now they were pleading with buy side to come and sit with them. So I was it. I was the analyst that turned up for De Beers, was one of hundreds to turn up for Data. I think we all know what happened. The ensuing 18 months, Data fell 98% and De Beers went up 72%. I like uncrowded trades, and I see crowding in bank floating rate notes now. So they've served our fund really well, and we've kind of getting out of those. There's been better value of late in fixed coupon bonds. But the yield enhancement is not an accidental thing that we build a portfolio and then, oh, look at that, the yield is higher than the Orbeez yield. No, this is engineered well in advance. We measure millions of risk metrics. Okay, that's hyperbole, but lots of risk metrics. And we pay a lot of attention to those because I've got all the time in the world because I'm not looking at the hazardous economic forecasts. I just pass on those and leave time for research pursuits far more likely to result in alpha.
Well, it pans out and if you're in your returns. Rory, back to you. Very last question for you. From our audience, I see you guys hold L3 Harris, with the stock having performed quite well in the past 3 months. At what point would you look at taking profit? Additionally, is the stock a long-term hold for you as they are in the process of acquiring AJRD?
Yeah, we added modestly to it yesterday, so maybe that answers the question directly. But there again is a stock, I think, that benefits from two dynamics. Firstly, growth in defense budgets, which in the last fiscal year was in the US at least at 10%, which is meaningfully above sort of the long run expected growth rate, but it says something about the imperative. And in L3 Harris, we see two company specific dynamics, a differentiated focus on a faster growing area of the defense budget, which is space, firstly. And then secondly, the person asking the question is probably very familiar, but they will know that L3 Harris is a combination of two businesses, L3 and Harris, going back about 3 years now, maybe slightly more than that. where one business was managed very, very efficiently from a working capital perspective, and the other not at all. A lot of it had to do with inventory management. And what we recognize, I think, within L3Harris is an opportunity to continue to grow free cash flow just through smarter working capital management practices, to grow working capital well ahead of any kind of revenue or market growth opportunity. The free cash flow that comes back to you and the yield that you can buy that growth at remains fairly attractive in our view.
Thank you for that. I think that gives us a lot of insight in terms of how you think about some of these holdings. There's a ton of questions coming in from the audience, but unfortunately, we're very much out of time. Maybe the very, very last question, Rory, and it speaks to the pond that you fish it in. You might mention that it is the MSCI All Country Index. But given what's happening with the reopening in China, a lot of talk about emerging markets, do you think there is sufficient exposure in the companies that you fish in to get earnings or to benefit from emerging markets? Or would you ever look at specific allocations to emerging market equities?
So we screen the all country world rather than the world, which is actually our formal benchmark. That means within the process, we have exposure, or we are uncovering emerging market opportunities in a competitively advantaged process, or focus on competitive advantage. So the developed world tends to overweight, and the US particularly. But nevertheless, there is exposure there. In terms of my view specifically, China and the like, I continue to have some reservations about the investability of some of the Chinese companies, and the dominance of regulators and markets. We know that story very well from a South African perspective, and the links into Naspers. My view is that the Chinese have taken the stance that they've taken is that Tencent offers too much systemic risk to the Chinese economy, given the omnipotence of WeChat in so many aspects of the Chinese economic life. And that ultimately means that returns are diluted down to utility type returns, which over time sort of approximate cost of capital. That means you pay a very different multiple for a business like that.
Can I have 10 seconds on that?
Right.
Eugene, that's super polite. Here's something for you. Years ago, I was asked about BRICS in my equity days.
Yes.
I think the South African regulator should ban South Africans protect them from themselves and ban them from investing in other emerging markets. So infamously, I blurted out one day when somebody was selling a BRICS fund, and it used a weak pun. You cannot build a portfolio without BRICS. And this team was a day ahead of me on a roadshow right around South Africa. And I heard about this, so I said, I'll give my own pun on that. If you as a South African think you're diversifying your funds by investing in other emerging markets, in particular BRICS, you will shit bricks one day. And so it has come to pass. It is just patently wrong for South Africans to diversify. 90-something% of equity market capitalization is in developed markets. We live and work in an emerging market in the other 10. Why would you seek to diversify in the other 9 instead of the other 90? Honestly, I've got a strong opinion on that. And China has been an unmitigated disaster for equities for a long time, as has Russia. And the correlation between South Africa and the correlation spiked to 1 at exactly times you don't need them. Think of Asia in 96, Asia in 98, Russia in 2000, and it will happen again.
If I can just add very briefly, I know we're probably out of time, but we do have exposure elsewhere in the portfolio through companies such as LVMH and Accor, which is a French hotel holding company, which have benefited quite meaningfully from the Chinese reopening, and we don't own them for that reason. It just happens to be sort of something that supports the investment case.
Rowan, I think you also addressed one of the questions from the audience on China. Gentlemen, with that, I'm going to end it. Unfortunately, we're very much out of time. What we are going to do for the audience, there's a couple of questions still outstanding. We're going to circulate the through to both Rowan and Rory. We'll get some comments on that for you. But as you know, with all our partners and fund managers, open door policy. If you really want more information, please let us know. We'll get you in contact with both Rowan and Rory. Gentlemen, I must say, and one of the comments from the audience as well, it does leave us with a warm feeling when we deal with Vunani and the high level of integrity that you've got in looking after our clients' funds. So thank you so much for the good work you do and the time you spent with us this morning. We look to see lots more of your funds in the near future. To our audience out there, just a very quick reminder, no boutiques on Wednesdays for the next couple of weeks because we've got our live sessions the 15th of February in Pretoria, the 7th of February in Johannesburg, and then the 22nd of February in Cape Town. That will be followed by our virtual seminar with our global managers on Wednesday, the 1st of March. And from there, we'll start with the normal boutiques on Wednesdays again. To our audience out there, thank you so much for your continued support. To our two formidable fund managers today, Rory and Rowan. Thank you so much to the BCI team for organizing this, Tanya and Olga. We remain ever grateful, and we'll see you at the live venues.
Thank you.
Thank you.